Okay, good morning. I'd like to welcome you all to our first in our new webinar series of investment updates for clients here at SG Wealth. My name, for those that don't know me, is Henry Gaskin. I'm the Chief Investment Officer here, and I'm very glad to say that today we've been joined on the call by Mike Appleby, who's an investment manager in the sustainability team at Liontrust. My role here as CIO is to head up our investment committee. We're responsible for the investment decisions within the firm and the governance and management of our model portfolios. They've been running for many years now, and over the last sort of half a dozen years or so, we've been running sustainable versions of those as well. And it's definitely an area we're seeing a great sort of increase in interest and demand from clients. Yeah, I think that's something we're seeing in the wider industry as well. I mean, in my inbox on a daily basis, we get emails about sustainability and ESG issues. So very happy we've got Mike here to provide an introduction to what all that means for you to think about. Mike's going to cover probably about half an hour around sustainability, but prior to that, I'd like to sort of recap on some of the events of 2020, talk about what's been driving markets, and also take a brief look ahead as to the sort of issues we're thinking about when we're sort of constructing your portfolios. Just a bit of housekeeping. We will be taking questions as we go via the Q&A function at the bottom of your screens. We won't answer them as we go. We'll put all those towards the end of the session. If we've got time at the end, myself and Mike will answer them. If there's anything really specific, either that unique to yourself or a real specific issue, we may well come back to you sort of after the event, if that's okay. But please, fire through the questions online and we'll deal with them as we can. Right, so I'm just going to turn my video off while we go into the bulk of my presentation. So yeah, what's been happening in 2020? So this slide, you'll see that markets have clearly been very volatile. 2020 has certainly been a year that will live extremely long and hard in the memory for many years to come. On this slide, we can see the performance of different stock market indices around the world. The blue line being the UK and other regions on there as well. And you can see actually in January, the start of the year, we started okay. The world was fair. The markets were fairly ambivalent to actually some pretty significant events that were going on. If you think back, we had the impeachment of the US president. We had a drone strike killing an Iranian general, potentially prompting into sort of the Third World War. We had massive apocalyptic wildfires in Australia. And obviously the UK officially left the EU at the end of the month. So despite that, markets were relatively sanguine during that. But as you can see, really into February and through into March, the effects of the sort of number one issue that we've all been dealing with came sharply into focus for the sort of Western world. The pandemic clearly has been the number one and really much the sole issue driving economies and markets this year. And really, at the peak of uncertainty as to how this was all going to evolve back in February and March, markets had an extraordinarily sharp sort of risk-off environment. We can see, most markets tumbled by 30–35% in a few weeks, and it was extreme volatility. Markets were moving by sort of 5 or 10% on a daily basis. That sort of environment is really a very tough one for investors. Very sort of difficult in terms of sticking to your guns and sticking to your nerves. But clearly, it's not an environment where making short-term knee-jerk decisions is going to be beneficial, because unfortunate or unlucky timing can really result in very material losses. But as you can see, after that very short, sharp contraction in markets, we've started to get a bit of clarity in terms of how the virus is impacting the world, how policymakers around the world would respond, and indeed that response that we've seen from policymakers has buoyed markets, and a recovery in stock markets has been again pretty sharp and pretty quick. We've We've seen that in different parts of the world in different degrees. The blue line is the UK, and we can see that we have been a bit of a laggard compared to some of our global peers, and we'll talk about some of the reasons for that in a little while. I guess the question we're all asking now is, as we enter the typical sort of flu season and around the world, is the recovery that we've seen in markets going to be sustainable? And the next few slides will help us sort of comment on that. So just to explore the COVID situation in a bit more detail, obviously the recovery in markets and the recovery in the economy will very much depend still on the course of the virus. And as an investment committee, we're monitoring that position on a regular basis. Indeed, it's actually quite hard for us to prepare presentations and literature to comment on this because it's such a fast-moving topic. These slides here are as at the end of September, and they're already sort of out of date. But they give you an idea of the sort of things we're monitoring. On the left-hand side, it shows case numbers around the world in different regions. And we can clearly see the second wave that we're all talking about sort of coming through into the autumn. The slide also probably is a little bit false, because we all know during that first wave, particularly in countries where there wasn't a robust testing process in place, that actually the case numbers that were truly in the population were far higher than being shown on these charts. Some estimates are the UK were 10 to 20 times higher than were being reported. So whilst the left-hand chart is useful in understanding maybe the momentum of cases, we also look at other measurables to understand the economic impact of those. The right-hand side chart looks at death rates, which up until now have remained a little bit more modest, which is due to obviously a better understanding of the virus and better medical processes and systems. But still, there is a concerning pickup in recent times that we're all aware of. One final point on this slide, so just to comment on, is right along the x-axis we can see a green line, which is North Asia. And we can see actually that the source of the virus, the original source, has been able to very much control it through comprehensive systems and processes. And indeed, that's fed through into a better economic outcome for them. This next set of slides, we've rolled the clock forward by just a fortnight. The data is similar, and it shows how quickly things change. The left-hand side again is case numbers, this time concentrating on Europe and the US rather than worldwide. And we can really see the sharp acceleration that we've seen in recent times, which is clearly a major issue for policymakers. Some of the naysayers, I guess, are saying, well, this is because we're doing more testing now. However, the right-hand side does show that that's not strictly the case. The right-hand chart is basically a chart that shows the percentage of tests that are being carried out that are being returned positive. So we can clearly see from that and that pickup that we've seen in recent times that it's not just the amount of testing that we're doing that's driving the case numbers, it's the spread of the virus that is resulting in these higher case numbers that we're seeing. So clearly that's at the forefront of mind for all policymakers at the moment. Not only to protect public health, which is obviously the number one priority, but also because we all know the severe economic impact of dealing with the virus. This next chart I've put up is data from the OECD, which shows the impact on different countries' economic output over the first 2 quarters of this year. The bar charts are the fall in gross domestic product in the second quarter of the year, when worldwide we were seeing comprehensive nationwide lockdowns. Whereas the diamonds you see within those bars are the falls we had during the first quarter of the year. As you can see, if we focus on the UK on the left-hand side, we fared a bit better in the first quarter than some of our local neighbours, because we were later with the virus. The virus spread from east to west, and indeed our response was later as a result of that. So our lockdown happened later on than the likes of France and Italy. and therefore the impact on our economy was delayed as well. But we can clearly see in the second quarter, when we were in full lockdown, a hugely significant contraction in economic output, of 20%, and indeed, UK was one of the worst hit sort of worldwide in terms of the economic impact. That again is reflected in this next slide, which is economic numbers and forecasts from Deloitte. And in the first table we see there, you can see the first couple of quarters are showing the same sort of data, a fall in economic output in quarter one and a very sharp contraction in quarter two. We also see, though, that there is an economic expansion and recovery expected in quarter three and through into the rest of this year. Obviously, it's a recovery from a very low base, from essentially an economic shutdown, but it's something that we are factoring in, and markets are factoring in when they are pricing. They are looking forward as to how the economy is going to be traveling from this point forward. The result of the contraction and then the recovery is seen on the right-hand side of that top table, with an overall contraction in 2020 forecast of around 10% for the UK, which clearly is a disastrous year, and quite unprecedented. But similarly, looking into 2021, the forecasters still think there's enough pent-up demand for the recovery to continue, and actually 2021 to be a relatively strong year of economic growth. And indeed, that sort of expectation is being reflected in markets at the moment. The second table at the bottom of this slide looks at some of the other major economies in the world, and you can see the shape is similar, albeit UK is suffering more so this year and potentially coming out next year a little bit better than some of its peers. The key point I'll pull out of that as well is China. They are pretty much the only major economic country that is forecast to grow this year. And indeed, next year, you can see growth is forecasted around 6.5%, back in line with previous sort of pre-pandemic expectations. So that highlights really how effectively China and some of its Asian neighbours has dealt with the virus through very extensive testing, track and trace, and other measures. Of course, while the economic numbers are terribly bad, they are only not a lot worse due to the massive support and stimulus packages that governments and central banks around the world have provided. This chart shows how much spending and loans have been pumped into the economies by governments around the world, very much at sort of wartime levels. For example, in the US, between April and June, they borrowed, I think over $3 trillion was borrowed to cope with the pandemic. And still, yet more continues to be expected to be delivered by governments around the world to continue the fight against the economic impact of the virus. So we all know that governments are spending huge amounts to support economies. We know they're borrowing huge amounts to finance these spending plans. But we all also know that this huge expansion of public debt worldwide cannot go on unchecked. Whilst the current low interest rates make such debt mountains affordable, they also make countries much more sensitive to the risk of interest rate rises in the future. Countries around the world have already started to ease back on the support, albeit now some of that easing back is possibly being put back in place as the virus reignites. But actually, as I say, generally things have eased back since the peak of our nationwide lockdowns, and as economies have started to recover. These charts here look at the very successful UK furlough scheme, which ends at the end of this month. On the left-hand side, we can see that at its peak, that supported around a third of all jobs in the UK. That's now shrunk to around 10%. but it's still a very significant scheme that's supporting a number of jobs, as the right-hand chart shows, across a very wide range of industries. I mean, it's clear from these sort of charts that we've looked at that the experience earlier in the year that we've seen, and the economic impact that's followed, the cost of these full country lockdowns is huge, and to repeat that on an extended, further nationwide basis will come at a huge price for any country. Therefore, what we've seen obviously in recent days and weeks in this country is politicians trying to strike a very fine balance between limiting the impact of the virus on public health, clearly a number one priority, but also looking to limit the economic damage if possible, because that damage potentially could be something we have to then bear the cost and live with for years and years to come. It's a very difficult balance, and of course everyone will have their own views on the rights and wrongs of this. But from an investment perspective, our role is to try and remain agnostic to the emotions of this, and try and monitor and understand what's going on and what the economic and market impact of it will be. So yeah, a few slides on the pandemic there, because clearly that's all that we've been focusing on pretty much over recent months. I was saying to my co-panelist Mike earlier that I was talking to my children about our presentation today last night, and told my son Arthur, there's too much COVID in the presentation. People will be bored to hear about it. And to which he responded, "But Dad, the world is only about COVID at the moment," and he's right, really. But having said that, looking ahead, we are focusing on a few other issues now, particularly a couple of major political issues either side of the Atlantic. So from an investment perspective, what else are we looking at? Well, probably another very significant issue that we're focusing on is the US election. In just under 2 weeks now, America goes to the polls to either re-elect Donald Trump or elect Joe Biden as the next president of the USA. The polls and the bookmakers favor Biden, as we know, and the sane amongst us may find a Trump win unfathomable. But that was also the case back in 2016 at this stage, when Hillary Clinton led the polls going into the last few weeks of the election. A win for Biden, particularly if it's supported by a blue wave of the Democrats winning both houses of Congress, would potentially see Biden look to reverse some of Trump's earlier corporate tax cuts that were quite stimulative to the economy in America. Furthermore, the Democrats might also look to restrict the powers of the big five technology companies, the Amazons, Apples, Facebooks, Microsofts, Googles of this world, as they've certainly made noises about that in the past. In isolation, this actually might sound potentially a little bit detrimental to those companies and a little bit anti-business. And you might think this might unsettle markets. And clearly there may well be volatility as policy gets announced. But on the flip side of that, Biden's also promised quite an eye-watering economic stimulus package that he would release if elected. And one must expect that he's probably going to look to be a little bit more open to business globally compared to Trump. So some of the long-term promises and long-term potential of Biden might offset some of the short-term worry that markets have if he were to win the election. If Trump were to win, we would probably expect more of the same. Unpredictability, irrational decisions, which themselves can often lead to market volatility, particularly on the global scale. And we may expect, given another 4-year term, he may wish to reignite hostilities with China and other trading partners. So certainly issues we're very much watching as an investment committee. A bit closer to home, obviously, the small issue of Brexit is also being closely watched. Trading terms globally is clearly a hot topic, and very much so between the UK and the EU. As expected, those trading discussions are going down to the wire. And I guess we've all been pleasantly relieved of a bit of a break from the noise around Brexit this year, but certainly over the next few weeks, we expect to hear an awful lot about how well the negotiations are going. I think indeed they're starting again this afternoon in London, I believe. The expectation is still, I think, that the UK may achieve, some sort of skinny deal with the EU, with some allowances around the border controls and tariffs, compared to the default position of WTO trading terms, which we will otherwise end up with. But I think, we are clearly watching this, but businesses are also watching this, and businesses have now had a reasonable amount of time to prepare for whatever the outcome is. I'm sure, regardless of the nature of any deal, that there will be some winners and losers from whatever deal is arranged. And that's both at a sort of sector and individual company level. One thing to say is that when we structure our portfolio, certainly at the moment, we are structuring them using active fund managers whose job is very much to understand how the economic background and trading background will impact on different individual companies. And we put our trust and faith in those quality managers that we use in our portfolios to understand those impacts and to try and separate the winners from the losers. So there are a couple of the main political issues, but there's also a number of other global trends and issues that we're watching at the moment. I won't rattle through that list, but you can see there's a lot of major issues which are really driving a significant amount of change in the economy at the moment. Many of these aren't necessarily new themes. Most have been around for several years now, but they all seem to have been drawn into much sharper focus during 2020. Indeed, as we'll see, many of these are completely aligned with the sustainability thinking that Mike and his team apply. So it's probably sort of fairly good time to start thinking about wrapping up my comments and handing over to him to discuss some of these issues in a bit more detail. But before I do, I'll just leave you with a couple of quick charts to demonstrate the point that that change and doesn't necessarily mean volatility and bad news for investments. Change also means opportunity. Just to highlight this is one very simple chart that looks back at the first 3 quarters of 2020. The blue line on there is the FTSE 100, our headline UK stock market, which we can see is down about 20% so far this year, including the impact of dividends being reinvested, I hasten to add, which adds about a 3 or 4% return to these numbers. And on there, I've put also the shares in Ocado, which are the best performing shares this year. So Ocado, as we probably all know, are online grocers, but also very much a technology company now. And they've been a great beneficiary of lockdown and a change in shopping behaviours. And the shares have responded and returned well over 100% in the first 3 quarters of the year. Compare that to the worst performing share in the stock market of Rolls-Royce, the very much beleaguered engine manufacturer. Their shares lost over 80% during those 9 months. So comparing the two is a 200% difference in return. So as I say, change brings about opportunity, which there's always opportunities to exploit. Just a quick footnote to this slide actually is shares in Rolls-Royce have actually doubled in value since the end of September. So indeed, some active managers may well have taken the opportunity to exploit that undervalued position as well within their portfolios. And just a couple of last slides from me. We don't here at SG Wealth, we don't necessarily look and research individual company shares. We don't put individual company shares in our portfolios. That's the job of the likes of Mike and his team at the fund management groups we employ. Our role is to blend those funds in a diversified manner to create a portfolio or a range of portfolios with appropriate risk and return characteristics. Here are our model portfolios over the last 5 years, ranging from our blue, our adventurous higher risk portfolio, which has returned over 50%, and our defensive, very sort of low risk portfolio, which has returned around 12%. You can see all of those portfolios deliver a different blend of risk and return to tie in with the client's objectives and appetite for risk. This is very much shown on this next slide, where you can see we've got risk represented by annual volatility along the x-axis and annual return on the y-axis here. And again, the same 5-year time period. So if we look at our adventurous portfolio, it's delivered nearly 9% return per annum with around 10% volatility, which is less risk than the UK stock market at over 12, but well over double the return. Indeed, our balanced portfolio, which is our portfolio with the largest amount of clients' assets, has roughly had half the volatility of the stock market, but again, nearly double the return at over, or just under 6% per annum. So we've been quite happy with the way our portfolios have performed in this year. Yes, they went down in value during February and March, and yes, they have rebounded as markets have. They will always have that sort of correlation, but they've done so in a way that we would have expected and in line with the risk characteristics that we position them for. And just to set Mike up, final sort of comment is around these two portfolios here. So the green is our balanced portfolio, and the purple is our sustainable sort of balanced portfolio. We call it ethical balance on this slide. You can see a very similar return from the two over the last 5 years of just under 6% per annum, and very similar risk characteristics. What's quite interesting, though, is if we look over the course of a shorter time period, over the last 12 months, we can see the stock market is still down 16% or so. So, still a terrible 12-month period for UK stock market investing. Our main portfolios have been relatively flat in terms of return, which we think is a reasonable outcome. But the best performing portfolios that we've had are our two sustainable portfolios on this chart, our ethical balance and ethical cautious portfolio, delivering sort of 3.6 and 2.9% respectively. More sustainable and ESG focused companies have definitely delivered better returns during this challenging year, as highlighted by these slides. And I think at this point I will hand over to Mike to explain why that has been and why he thinks this may be set to continue. So over to you, Mike.
Great, thank you very much, Henry. I'm just going to swap over to my set of slides, which hopefully you can see. So yeah, I want to, my name's Mike Appleby. I'm part of the investment team at Liontrust that run the Sustainable Future Funds. And the objective of this session is to help you understand what sustainable investment is, and to look at the ways that extra research is done in these funds, which can actually help in delivering longer term investment returns. So I'm just going to start off by, sorry, one second. So what are the objectives of sustainable investment funds? And there are two objectives. One is to outperform conventional benchmarks, the market, by investing in sustainable companies. And I'm going to talk a little bit about what we mean by a sustainable company a little bit later on. And then the second thing is to encourage the companies that we're invested in to improve the way in which they're managed, in particular looking at their interaction with the environment and society, and indeed how they're governed. Now, we work in financial services, and unfortunately there are millions of three-letter acronyms describing sustainability, ESG, which stands for environmental, social and governance. But I want to just break it down to show you that there are three broad approaches that sustainable investment funds can take that mean that the stocks that they're invested in underneath are different from that in a conventional fund. So I just want to run through these three approaches. The first one I've called that ethical. This is about avoiding controversial industries such as arms, tobacco, pornography, and gambling, but there are other areas that are avoided as well. And this is all about what the fund doesn't want to get invested in. These funds have been around for a long time. The Pax fund in the US started in the 70s, and this is something a lot of people are familiar with. The second approach that can be used, I've called this sustainability themes. This is all about trying to find companies that are going to benefit from big positive trends that are going on in our economy. They're delivering positive outcomes in our economy. And as a result of increased demand for those services that we need, you can find companies that are really interesting investments because they are exposed to this long-term structural growth. And if they're profitable, they can be really interesting investments that generate great investment returns. And that's very compelling for a lot of people. If you can invest in the potential solution providers to some of the problems we got in trying to develop in a more sustainable way, that's something that many people find compelling. So that, if you want to think about it, is about what the fund does want to invest in. And then the last bit, I've mentioned it earlier on, is to do with engagement. This is about encouraging businesses that you're invested in to be proactive in the way they manage their business. And the kind of things that sustainable investors will be engaging on over and above the usual governance stuff like independence of the board, whether they're paying themselves too much money, whether that money is aligned with shareholders, etc. Is that business's interaction with society, and that can include, operational performance. It can include environmental performance. It can include things like human rights in their supply chain, etc. So those are the kind of things that sustainable investors are engaging on to make the company better managed, which can ultimately result in better investment returns over the medium term. Now, in reality, what happens is a lot of funds are a hybrid of these three approaches. They avoid negative screens. They have negative screens to avoid controversial industries. They're trying to get exposure to these sustainability themes, which is where you can generate some interesting investment returns. And they also are engaging with companies. What makes this different to a conventional fund is this is happening systematically with every investment decision. And that's not something that you get in conventional funds. And this extra analysis ultimately helps us make better investment decisions, we believe, over the medium term. So let's just think about awareness and demand for sustainable investment products. So it's going back a few years now, but the Blue Planet really raised people's awareness about what we're doing to our environment, particularly in form of plastics, which ultimately, many of which end up in our oceans. We've seen activists, climate activists like Extinction Rebellion and Greta Thunberg bringing climate change, quite rightly, I believe, much higher up the agenda. And then in the bottom left here, we've seen extreme weather events. The bottom left picture is in France a couple of years ago, where there was a heat wave well over 40 degrees. The country almost shut down. And these are pictures of people in front of mist machines trying to cool down so they don't conk out in that extreme weather event. Closer to home in the middle, at the bottom there, that is a 300-year-old bridge that got washed away in the summer, last summer, as a result of extreme flooding, extreme weather event. And we've seen increased incidents of wildfires, etc. But it's not all just about the environment. And this on the bottom right, this rather shocking analysis from the BBC still shows that companies in every sector still pay men on average more than women. And this has meant that people are thinking, we want to do something about this. There must be a smarter way for us to develop to try and address some of these issues. They're changing the way they consume and the products and services they're buying. And they're also making the connection that they want to change the way they invest as well, to include this proactive idea in how the money that is being invested for their pension or whatever is where that money's going, and the message that's going to companies that that money's invested in. So we're seeing huge interest and growing demand for these sustainable investment funds. And I would say that of the polls that come out on average over the last 5 years or so, we're consistently seeing that about 2/3 of private investors are interested in sustainable investment and want to learn more about it. So there is, and I think it's very nascent at the moment, there is going to be continued structural demand for more sustainable investments for people to invest in. Let's talk a little bit about investment returns. And there is a lot of empirical evidence to show that better managed companies, the ones that are ranked better in terms of how they manage that interaction they have with the environment and society, and indeed how they're governed, the ones that are ranked better in terms of that deliver better investment returns. And this is a seminal paper done back in 2015 by Frieda et al. And it looked at over 2,000 peer-reviewed journal papers to see what the results are looking at this interaction. And yes, there were some papers that showed a negative relationship between the better ranked in terms of ESG management companies delivered a worse investment return, but the overwhelming majority of them showed a positive relationship between how well a company manages their business and the resulting investment returns that they might get. So this really overturns that whole idea that by being proactive, that you're necessarily going to be making lower financial returns. This isn't to say that all sustainable investment funds will outperform the market in all conditions, but I'm just showing you that there is increasing evidence for this link between proactive management and better investment returns. So how's that possible for these sustainable investment funds who can't invest in some of areas of the market and yet are still able to deliver competitive investment returns? We saw in that chart earlier on that there isn't any evidence to show that you've necessarily given up any investment returns as a result of investing in these sustainable investment style funds. And indeed, there are many funds that are out to 10 and 15 years still have that relationship. They're still delivering very competitive returns versus their mainstream peers. So the reason why is this: there's extra analysis that fund managers do that help them make better investment decisions. And there are two areas that extra analysis happens. One of them, unsurprisingly, is how well the business is managed and understanding what is material for that particular business in terms of environmental, social, and governance, and how good are they at managing that. And we see a huge divergence within the same industries. It's not the case that they're all, all telco companies are all exactly the same, or all pharmaceutical companies are the same, or all industrial companies are the same. There are massive differences within the same industry. You have some very proactive companies that are using this as a differentiator to outcompete their peers. They believe that by having more sustainable products and services, that they will gain market share from their peers. And then there are really reactive companies who don't like talking about this, don't want the world to change. And so that's an interesting thing, which we believe is a proxy for the quality of management. Generally speaking, really good management teams that are going to deliver on their strategy over a 5-10 year period also happen to be very on top of this kind of stuff. The second area, which I want to spend the rest of this session talking about, is understanding longer term trends. The market is not particularly good at thinking about what's going to happen over the next 10, 15, 20 years. It's much more occupied with what's going to happen over the next 6 to 12 months. But we believe that companies that are the right side and experiencing a tailwind as a result of these positive trends make much more interesting investments than companies that are having to fight against these trends, to fight against regulation. So it's these two areas where this extra analysis helps us make better informed investment decisions that are going to deliver over the medium term. So let's think about these trends. So there are lots of trends, positive trends right the way across the economy. Yes, environmental technologies such as water and waste treatment and indeed renewables, they're really important. They're critical, but they're not the only sustainable themes or trends that are out there. I typically regard them in three buckets. So you can think of it, one of them being resource efficiency. It's all about using our resources, our finite resources, more efficiently, and that includes, water and waste and those things that I've spoken about before. Innovation in industry to become more efficient, and then the second bucket is really to do with our quality of life. So this includes things like quality education. It includes improving the way in which we can manage disease, and ideally trying to encourage people to have healthier lifestyles so they don't get a lot of these diseases in the first place. And then the final section or bucket that I would put these positive trends into, I call it safety and resilience. So these are companies that are making the systems we rely on more resilient. So a classic example here would be cybersecurity. As more and more of our lives go online, it's critical that that is kept safe. And if you talk to chief technology officers at companies, the one area they're not dialing back their spending is on cybersecurity, because, as one of them said to me, Mike, you only know if you spent enough on cybersecurity when it's too late. So what I want to point out here, though, is that there are lots of different big positive trends going on right the way across the economy, and that enables us to build portfolios that are diversified. And they're all going to be experiencing, this helps us find structural growth. So what I mean by structural is that it's less reliant on GDP and the economy going up and down. It's more about trends that are happening within an industry. And so we can find growth within our areas, within our economy, even if the economy as a whole is perhaps not growing that much, or possibly even shrinking a little. So I want to talk about two big trends. The first one is climate change, which is, if you like, a meta trend that affects lots and lots of different industries and different sectors. And then I want to talk more specifically about a company which is related to innovation in healthcare. So we are in a climate crisis, and the time to invest and drive towards a much lower carbon economy is now. The natural services that we all rely on for things such as regulating our climate, the water cycle to provide us with fresh water, natural flood defenses, indeed the way in which we grow food. All these systems are under immense pressure from human activity, and they're all linked. And one of the things that is driving this is climate change. And when we think about climate change, the electricity we consume is important. Renewables are very important, and replacing those fossil-fueled electricity generators with renewables is a key part of it. But if we replaced all of the electricity generation on this planet tonight with wind and solar. And when we woke up tomorrow morning, we would have decreased our emissions by about 1/4. So while electricity generation is really important, and it's great to see that wind and solar have plummeted in their costs and are now the cheapest form of new electricity generation in many parts of the world, and that's really positive. But we also need to look at other areas of our economy, such as how we heat and cool buildings, transport, industry, agriculture, and indeed the way we use land and how we that gets changed as well. So it's a very broad-reaching theme here and challenge we have. Since the Industrial Revolution, the global average temperature has been rising. It is now about 1 degree warmer than it was in 1880 on average on this planet. There is the international agreement, the Paris Accord, to try and limit that global average temperature rise to 1.5 degrees or less than 2 degrees. And what we can see here is that if we're going to try and stop to that 1.5 degree area, we don't have a lot of room left. And this piece up here shows that if all the current policies we had were enacted, they were done. It's likely that the global average temperature is still going to rise somewhere in the order of about 3.5 degrees. Now, 3.5 degrees might not feel like very much to you, but it is a massive change. And as we get up to there and towards 4 degrees global average temperature rise, the risks of runaway climate change increase. And indeed, our ability to be able to feed ourselves and grow food in some parts of the planet are going to be severely compromised. So this is a major challenge that we have. But as you can see, because we are not going to meet this target at the moment, you can expect global regulation to increase to reduce those emissions going forward. And that's going to have a massive impact on businesses and a massive impact on the investment returns that you're going to get within them. There are some obvious winners and some losers as well. So I'm just going to quickly rattle through these. Renewable energy is clearly a beneficiary of this. And we see a lot of opportunity in energy efficiency. This is about companies that are making investment returns by reducing the amount of energy we waste. What that means is that user bills for energy come down, and in doing both of those things, emissions come down as well. So there's some really interesting areas in building insulation, companies like Kingspan, where 80% of their products are all about reducing that wasted energy in heating and cooling our homes. There are efficient lighting companies that use light emitting diodes, LEDs, which are much more efficient. And also companies like SDCL, Energy Efficiency Income Trust, which is a business that's investing in assets that are energy efficient, that are reducing that energy wasted. And so there are lots of really interesting opportunities there. I just would say that I'm not recommending you buy any of these companies that I'm mentioning in this presentation. This is a sort of general presentation, and I'm trying to give you a flavor and some examples of the kind of companies that are here. But please don't go out and buy any of these because I'm not telling you to do that. I'm just trying to get some examples going. We think there's going to be huge disruption in transport as well, and there are some really interesting companies that make the widgets, if you like, that go into vehicles that are electric vehicles or hybrid vehicles, which we believe are going to continue to accelerate that adoption and will be a very big disruptor within transport. And then there are some industries which are going to lose. So incumbent industries that are carbon intensive, where there are lower carbon alternatives, we think are really going to struggle to survive, and many of them aren't going to make it. Okay, so we've talked about a big theme, climate change and the climate crisis. I want to talk about how someone picking stocks, making investment decisions, includes this sustainable bit in an investment process. Because it's not just about thinking, oh, right, I want to find some really nice companies that do really nice things and buy those and hope that they're going to outperform the market. We think that's unlikely to happen. But we believe that any investment needs 4 things to be right for the chances of that investment outperforming to be high. So we've talked about the trend in the top left here. Being the right side of the trend is very important. You don't want to be in a business that's fighting against that trend. The quality of the management team, as measured by how well the business is managing those environmental, social, and governance aspects, is critical as well, because that's going to help you have a proxy for the quality of management that they're going to deliver on that strategy that they're communicating. So those are the 2 sustainability aspects, if you like. But we also believe in the top right, business fundamentals need to be right. And this is essentially that it's a profitable business that's making decent investment returns, and it's doing something that's difficult to replicate. And then finally, valuation. We want to have some reassurance that it's likely that this company is going to be worth a lot more in the future, say in 5 years' time. Because it is possible to have all the other things, but have a company that essentially has all the good news in the price and is essentially fully valued. So it's when these 4 aspects are all positive, that's what we would define as a sustainable investment. Let's look at another area, and I just want to talk about how we deal with healthcare, how we manage disease. So let's talk about healthcare spending. This is all pre-COVID-19, but it's a theme that's still happening and will continue to happen when we get through this COVID thing as well. So the amount spent on healthcare is very high. In the UK, it's about 10% of our gross domestic product. And in the US, it's an eye-watering 17% of GDP. I'm going to concentrate on the US for the rest of this example. This healthcare expenditure is expected to rise at around about 3% a year on average for sort of developed markets. And we're also seeing that big pharmaceutical companies are finding fewer drugs for every unit of research and development, every dollar of research and development, if you like, or every pound, they're finding less drugs. So what we really need is we're looking for innovation. We're looking for something that can deliver better patient outcomes, but also doing it in a more cost-effective way. Now, I'm not talking about sacking frontline staff to make savings in healthcare. I'm talking about parts of the system that are inefficient or people haven't really thought about, where there are efficiencies that can be made. So we're looking for that innovation to provide better patient outcomes in a more cost-effective manner. Let's just think about drug trials. This is massively relevant to us all now, in hoping that we are going to have a timely vaccine to be able to, manage this COVID-19. So what happens is a drug is tried out on a small number of people. If it works, it then goes into phase 2 on a bigger number of people. And then if that works, it gets moved into phase 3 drug trials before going on to be approved. And the purpose of these trials is to make sure that the drug is positive, has a positive, is effective, but also that there aren't unintended side effects that come out that actually nullify those positives. Designing these drug trials is pretty complicated, because to be able to answer that question about what are the side effects, you need to have lots of different candidates who are of different ages, different backgrounds, who have different existing conditions, to make sure that there aren't some people that are going to be negatively affected by it. To give you an idea, the cost of a phase 3 drug trial that goes on to be approved and to be used in the wider public, it ranges from about $2 million to $400 million. That's a big number. It's not a huge number compared to the cost of developing a new drug. But what happens is in these situations is 80% of drug trials take much longer than expected and therefore cost a lot more. So they're pretty complex. And this is an area where we think there is room for improvement. So IQVIA, again, don't go and buy this. This is just an example. IQVIA is a really interesting business. It's a US company, market cap of about $45 billion. And they have data on prescriptions in the US, every prescription in the US, and they're even able to tell whether people are actually taking those prescriptions or not by whether they're renewing those prescriptions. And they have designed, they've built some software that can help design, plan, and monitor drug trials. And the critical bit here is about getting the right candidates to take part in the drug trial so that you're able to come out with the answer whether the drug is effective or not. They also actually run drug trials themselves. So they have these centers in parts of the US where they will run the whole drug trial. And they are able to do this much faster and at a much cheaper cost than the incumbent pharmaceutical industry that have been doing it. To give you an idea, there was a breast cancer drug that they managed to get done 3 months quicker than the average had been done for similar drugs. And if you think about that 3-month period, that's a really critical amount of time while we're thinking about COVID-19. That 3 months could make a huge difference to billions of people's lives. So they're really, really good at this. And it's no surprise that the pharmaceutical sector are using IQVIA because they're just much better at doing these drug trials than they are. So if we go back to those 4 aspects that I was saying was really critical for a company to be a sustainable investment and most likely to outperform the market. In terms of the theme, the whole business is pointed at this. This isn't just sort of 5% of the business. It's all about improving drug testing. The company's revenues are growing at around about 7% a year over the next 5 years on average. That is structural growth. The quality of the management team we think is good. We have our own way of doing this. I won't go into that now, but they're managing the key aspects, and we think that they're a good management team. The business is making 25% returns on invested capital. The investment returns they're making are very, very good. And in terms of valuation, we believe that there is still significant upside on a 5-year view for this stock, that the market isn't really appreciating this continued profitable growth that we believe they're going to experience as a result of delivering better patient outcomes. So in sustainable investment, I'm slightly running out of time here, but you do get additional reporting. So this, for example, is the Liontrust Sustainable Future Global Growth Fund. It's a global equity fund. And you can see that in those 3 buckets I talked about earlier, it's about 1/3 each in terms of resource efficiency, improving health, and that safety and resilience. And these are the 20 themes that we happen to use. And it shows how much of the fund is invested in companies that are helping to deliver on that particular theme. If you're not aware of them, the United Nations Sustainable Development Goals are getting used a lot more now. These are internationally agreed goals to try and hit by 2030. They replace the Millennium Development Goals. And it's a useful vocabulary for people to understand sustainable development. There are 17 goals. And what you do is you will see funds that map those themes that I talked about in the previous slide through to these sustainable development goals as well. And that's something that we're seeing a lot of appetite for. You're also going to see these, they're already littered around in annual report and accounts. But you need to be careful because many companies are quite good at showing all the good bits where they're positively impacting the SDG goals. But you need to make sure that you understand where there are negative things that are adversely affecting these as well, so you get a picture of the whole business, and that's what we do. The other area where you'll see additional reporting is particularly on carbon, given climate change is such a big and important issue. So this is for that same fund. It shows that the companies that this fund is invested in emit 91% less carbon dioxide from their operations than the market as a whole. About a third of the portfolio is invested in companies which are directly cutting carbon emissions through their products and services by using them. And finally, we have no investments in companies that are invested in, that are extracting or producing fossil fuels, and that includes coal, oil, or natural gas. And this is interesting because if we go back to that point before where there is going to be increased regulation to reduce greenhouse gas emissions, what will happen to any company is if we woke up tomorrow morning and there was a cost on carbon that was much higher than today, the business would try and pass that on to their customers. If their customers weren't able or prepared to take that cost on, the company would have to bear that cost themselves, and that would mean their margins would go down. They would be less profitable. And what this shows is that the companies invested in this fund have 91% less carbon costs to pass on to their customers, and therefore they will be resilient as compared to the market to future regulation to curb greenhouse gas emissions, which we think is inevitable coming down the pipe. So just to summarize what you get from sustainable investment, it's invested in companies that are essentially making the economy cleaner, healthier, and safer. The fund manager is engaging to improve those businesses, to better manage those environmental, social aspects, and indeed how they're governed. They avoid controversial industries, and they are there to deliver competitive investment returns versus their mainstream peers. That's it from me. I don't know if anyone has any questions. I will stop sharing that, or whether any questions have been coming in from clients.
Let me just rejoin. Thanks, Mike. That was fascinating, very interesting, and I'm sure quite thought-provoking for a lot of people. Yeah, we do have a little bit of time for questions. I know we've sort of overrun a little bit, but sort of we can take a couple of questions for sure. For those less familiar with Zoom, there is an ability to submit questions down at the bottom of your screen using the Q&A function. And yeah, please feel free to do so. We haven't got time to pick them up after today at the session here. We'll pick them up afterwards. And indeed, if you have any questions afterwards, please fire them back to your wealth manager, your direct contact, and we can either get an answer from our investment committee or indeed from Liontrust. Just before we go on to the questions, we have had a couple in. Mike's probably too modest to say, but I would also like to just sort of vouch for the success that Liontrust have had in terms of applying their investment sort of philosophy and process. We do hold a number of their funds across a range of our portfolios and strategies. So, they very much are very successful at sort of what they do. And I mean that ties into one of the questions actually. That success is long term. We've been long term investors in these funds for a long time, and that does tie into one of the questions actually we've had. The question was how much really is sustainable investment sort of more of a short-term theme based on the people's sort of focus on environmental and social issues, or how much of that is it more a sort of a long-term theme that one can exploit? So I don't know if you want to comment on that.
Yeah, no, thanks for that. So yeah, when I started doing this 16 years ago, it wasn't very fashionable. We were thought of as very weird, and we were probably misunderstood. But those trends that I was talking about, climate change, the need to use our resources more efficiently, this whole COVID-19 thing that's been happening, and a massive re-understanding of our healthcare systems, etc. These are very long-term trends. They're not going to get fixed in the next month or so. So I do think, indeed, the reason why we do that work on those long-term trends is these are trends that are playing out over decades. So I think that answers your question, hopefully. I think these are long-term trends. I don't think this is something that, I think it's very unlikely in 5 years' time we are going to be sitting here saying, well, we've fixed climate, we don't need to worry about that. I think it's critical for our whole economy to develop in a smarter way that has less of a negative impact on society, but also that tries to close that ever widening gap between those that are winning, the haves and have-nots. I think that inequality is something that we need to try and address as well. Hopefully that answers your question.
Yeah, thanks. I guess another one on a similar sort of theme, a bit more of a short-term view though, is around valuations we've had. Someone suggested that some shares look sort of crazily overvalued. They've quoted Tesla to name one. So how far do you actually use traditional sort of current valuation concepts, and maybe to balance that against sort of future longer term prospects? How does that fit into your process?
Yeah, so I think on some of these stocks, so first of all, we don't own Tesla, but on some of these stocks, they can look very expensive on 20, 30 times next year's earnings or something. That's not true for every stock that we own. But we're thinking about what that company could be worth in 5 years' time. And we are looking at the degree to which that company can grow and the margins that it will have through that period. And so they are very traditional valuation techniques that we're using, if you like, looking out to 5 years. And that valuation is the main trigger for us to sell out of a stock. If we own something and we think it's achieved or is even gone slightly through a price target that we have on a 5-year view, we will review it. And if we believe that's overvalued, then we would sell that company. So that's critical to have that in your investment process.
Good.
Hopefully that answers your question.
Good, thanks. And maybe one more for you, Mike. I know we have overrun, but last one. Just in a question about how you hold companies to account. So I guess how do you engage with them, and how do you sort of challenge them on some of their decisions in these areas?
Yeah, so we are very active shareholders, and we vote at AGMs. We think it's a really useful way to get the board to think about things, and we're pretty aggressive on that. So of the companies that we own, typically over 2/3 of those companies we will abstain or vote against something at the AGM because we want them to make some changes. And the way we look at our engagement is we have priority areas at the beginning of the year. We normally have half a dozen things that we're going to focus on to talk to companies throughout the year. And we try and keep those issues going for a few years, because we think that the way you get meaningful change from companies is not by simply writing an email to them, but it's about having a dialogue with them over a 3-4 year period, and encouraging them to be proactive in the way that they've managed it. On our website, we liontrust.co.uk/sustainable. In there's quite a lot of information about what those priorities are. One of them is our 1.5 degree climate change challenge, where we're asking companies to go away and be more ambitious about the rate at which they're going to decarbonize their business, because we think that will garner them a competitive advantage, but also there is a necessity for us to do that as well. I'm sorry we seem to have run out of time, but thank you for those questions.
Yeah, thanks again, Mike, and thanks to everyone listening. We are having a bit of a focus on sustainability at the moment. Our next edition of our client magazine will have a sustainability theme to it. So there'll be some more information there. And as I say, if you're interested to explore or discuss some more options and some more information around this, please pick it up with your wealth manager after the call. One final thing to say before we close the call is this is our first webinar, so we're very interested to hear any feedback that you have. You will be sent a survey afterwards just with a few questions. We'll be intending to run investment updates on a quarterly basis, but we can also run presentations around sort of other matters, other general financial planning matters. So please let us know what you want us to talk to you about. And we look forward to receiving that feedback. But just to close, thanks, Mike, for your time, and thanks to everyone for their input and your attention during the call. Many thanks.
Thank you for inviting me. Thank you very much.